Hello everybody, it's me, the Boss Hog, and today we're going to look at my stock portfolio as of the end of March or the start of April. Full portfolio walkthrough, all of my positions, how I'm doing, how I'm feeling about it, etc. Let's do it. Alright, so as an overview, at least we're profitable again, although only just, and again that's thanks to dividends. For anyone who's new for this, the top table here is basically self-explanatory. The yellow highlights are basically the month in question. Then that reconciles with both the bottom or middle left and middle right tables. So the middle left is basically my realized and unrealized positions, which kind of matters when we're looking at my current portfolio, right? I'm quite an active trader. I don't really sit on like huge, multi-baggers or anything like that. That might be to my own detriment. But it does mean that it's important to distinguish those two things. I do have some dividends, and then an overall profit. So you can see my overall profit is 1306. That reconciles with the profit in the middle right table, and likewise the middle right table there, the 97384. That's going to reconcile with the overall, value as of the time of recording this. So 97384 there as well. So that's how it all ties in together effectively. So, no further falls from my polymetal or Evraz positions. These were my Russian miners. I actually had quite a material stake in. Obviously, they've been hammered because of the situation in Ukraine. So I'm sitting on an unrealized 9,000 loss on those two holdings at the moment. So I guess how am I feeling after March? And it finished like minus 2.7, I guess, as a net. I guess kind of okay. It had been like minus 9,000 and it had been as high as plus 3,000. It was still a really swingy month. Obviously, I'd have liked to have finished green just to sort of, because now it's like 3 months lost, right? But at the same time, it could have been a lot worse. I guess somewhat, maybe I'm just a bit of a grump when I'm recording this, but I wish it would almost stayed that bad because it was getting to the point where there were like some really good bargains. I reopened positions, for example, in like a couple of UK insurers and got great averages on them, and I wish I had more capital and the ability to add more capital at that moment in time. But that's not to be, and actually I still don't think the market is expensive as it has been in the past. So on balance, I feel okay. I have been reviewing my portfolio reasonably regularly. I do weekly videos as well, and I review my top 10, any news, etc. on a weekly basis. So, and that consists of almost 90% of my portfolio. So it's a chance to really make sure I'm happy with certainly my larger positions. So otherwise, I feel okay. I'm not going to lie, I'm looking forward to it being a green again, but there's a long slog to recover from the highs I had sort of 3 months ago, as we'll see now. So yeah, I'm definitely not enjoying these graphs as much as I was a couple of months ago. I sent this top right graph to a couple of friends as subscribers in the middle of January, and the blue line was actually ahead of the red line because the month end is what we're really looking at here. So when I sent it to them in the middle of January, it's looking pretty good. And then the Ukrainian war happened. You can kind of see in the top left graph where that happened because it's just nosedived basically from being up like 16,000 profit to being down sort of almost 10,000 or worse, right? So like over a 20 grand swing it was in terms of profitability, which is huge, right? When you look at the value of my portfolio, that's a significant amount. So that was pretty brutal. On the good side, I didn't panic sell anything. I've still got those two Russian miners if they ever recover, but mentally I've kind of prepared myself that I might just lose the remainder. Right now, though, I've lost 9,000. I've only got about 1,200 left in them. So all the damage has already been done, and I've kind of mentally accepted that I might just be losing 100% of them, right? We'll see. I'm not panic selling, so we just sit on them from here. The bottom left here is my overall portfolio value. So again, this 97384, it's going to reconcile with the portfolio, right? And again, these are month-end totals. It does fluctuate during the month, because it's a live Google Docs document. But yeah, so unfortunately, we're not back into the six figures yet. I did get back into the six figures during the month of March, but unfortunately didn't finish there. So we are persevering, even though, like I say, it's not the great graph overview that it was just a couple of months ago, unfortunately. Okay, so I actually got rid of 6 positions, so from 30 to 24, but 4 of them were related to sort of portfolio rejigging in expectation of a new tax year. So basically moving stuff from a non-tax efficient account, and then I'm going to reopen positions when I can as of the 6th of April. A couple were just basically rationalizing down. So I kind of view it almost as trimming, even though it's not. And again, next month I actually expect to be back up to more or less 30 again. So the biggest changes this month are actually in technology and consumer discretionary, and that's a lot of that is to do with the fact I was buying a lot of like Genius and Games Workshop, so 2 of my top 5 positions anyway. And also Hollywood Bowl actually became my second largest holding. I haven't bought any more shares, although I have a lot of shares in them, just because they had a very solid month. So that was, again, consumer discretionary. So I'll talk more about them at the end when we look through all of my holdings. But as a result of those two things, they saw the biggest changes. There was a smaller increase in my financials, to be fair, and then slight reduction elsewhere. But you can see here, I have a very wonky graph sector split. This changes quite radically. 6 months ago in September, I actually had a profitable September because I was very light in technology, right? And then I moved into technology, as it turns out, slightly too soon. But in fairness, a lot of my technology does actually look quite good, except for Genius, and that would have been the case also many months ago too. Again, I'm happy with my graphs here. I don't put too much worry into having the right split. Again, I'm not like a fund manager or anything. I just do what I think is best. Mine always work out for the best, but that's my general approach here. All right, so honestly, a pretty decent March. I was quite surprised when I saw my dividends from March. Games Workshop, I was expecting, right? But this is like a FTSE 250 company that, to use their wording, they give dividends when they have truly surplus cash, right? So it's not like a dividend growth or anything. Although I would actually point out that they're about a 3% yield at the moment, just because they do throw off a reasonable amount of cash. So, but it's quite irregular. But again, I'm expecting a pretty decent one next quarter as well. They've already announced it, so that'll be like a 3-figure dividend for Games Workshop. So that feels pretty good. I hope they keep that up. But actually, to be fair, like when I was thinking about my dividends, like for the year and when they were going to be falling, I hadn't opened positions in either Amcor or T Rowe. These are both relatively new holdings in the last quarter. So again, I'm really happy with both of my buy prices here. Amcor I've got under 22, T Rowe I've got 144 as an average, and I've got good positions in both of them. I would have liked to have bought a few more shares in T Rowe, but I'm not going to be buying now. It's back above 150. But again, I've got a mid-sized position here, about 4% of my portfolio, so that feels good. And Amcor I think is really undervalued in the semiconductor space, so I'm going to be buying if it's under my buy price. Basically, if it's under 22, I will be gradually buying. If it approaches 20 again, I will be buying a lot. So that's my position there. So I was really happy with my March. Not only is it above February, but it was actually above March 2021. Especially, well, once you strip out my Tesco, so that's a pound sign Tesco, not Tractor Supply, which I appreciate shares the same ticker. But Tesco, they had a big special last March. That's going to skew that. I'm not actively a dividend growth investor, but I must say it's something I want to be working on, right? If you look at my holdings here, like Amcor, to me, like they don't have a particularly high yield, but actually they increased their dividend 25% in the latest run. So that's a lot of promise. Likewise as well, my third largest holding, I want to say, Gamma, they're a very stereotypical growth play, dividend growth play. It's like 13% year on year. They've set themselves to have 11 to 15% dividend growth for the foreseeable future. They're very typical. So I am gradually moving into dividend growth. I sort of drank the Kool-Aid and starting to really enjoy it. And to be honest with you, when I didn't get any dividends for December, I really missed it. So I think sort of a combination of those things, plus the fact I'm feeling quite beaten up over the last few months, right? Dividends are a shelter when things are a bit rough. And again, having this money come in just feels really good. So that's the approach here. And yeah, although I've sold out of a lot of the smaller dividends I've got this month, I've been adding to my shares in Games Workshop. That feels really good for me. I think they announced a 70p a share, so 154 here. Like I say, it's going to be really good. And then likewise, I'm hoping that Amcor and T Rowe are going to be on the up, as well as sort of seeing that dividend come in as well. So actually, I'm quite happy with my dividends this month. That was of all the things going on, the dividends was the thing that I was probably most happy about, in honesty. So anyway, enough teasing. Let's have a look at my exact portfolio as it stands currently. All right, so these are all 24 positions that I have currently. Just as a reminder for anyone who's new in terms of the method here, it shows active positions only, and then it shows the P&L of those active positions as a combination of both realized and unrealized. So, you might look at smallish holdings and see particularly good profit, even though, it's not the fact that I have a ridiculous buy price currently, it's the fact I might have sold or bought things in the past, right? So that's how this works. I don't want to spend a ton on the top 10 because as of about 3 weeks ago, I kind of gloss over them in my weekly update videos. I would just say that National Express I still believe is a good long-term hold that's fundamentally undervalued, and also I'm expecting a dividend to be restored at some time this year, so that will be great. Hollywood Bowl, I think, has been the best performing over the last month. A weaker competitor and a smaller competitor released really good results, and it rose in sympathy. In general, though, like I think analysts are not optimistic enough about Hollywood Bowl. The reason I think I'm on the upper end and actually kind of really pushing the very upper end of analyst estimates in terms of earning expectation is because when you look at on their ARPU, average revenue per customer, effectively, they call it LFL. Okay, fine, but it's basically average spend per customer per game. That's looking really good and moving in a great direction. And then I've just extrapolated up based on new site openings. So I think that's a reasonably fine and not particularly creative way of going about it. So it has been attracting a lot of buy prices as well. And it has gone up about 15% over the last month. So actually that's kind of pushed this. I think it was actually fourth a month ago, but kind of through natural growth and sort of some struggles from Gamma and Games Workshop, it's kind of risen up there. Gamma had results that got beaten up yet again for the second time in a row. I work in the industry. I think Gamma's a class outfit that's built a really scalable solution. I think it's got great numbers, and I think currently it's a real buy. I actually expect Gamma to become my largest holding within about 3 months. Just because I will actively be buying lots more shares at current price. I just think it's a really great long-term dividend growth play for me. Games Workshop put out a reassuring trading update, basically saying in line with expectations. The share price went up like 10%, but it has kind of settled. And but to be fair, I still think it's a really good company that kind of has some short-term challenges to work through. But I like it, and again, it's starting to throw off cash and become almost like a dividend play, which is nice. I think I have a good buy price in the 80s, but you can see here I'm down 1400, so the better part of 10%. But again, I'm quite happy with my holding and buy price here. Again, really quality company. It's in the process of expanding. It's got logistics costs. Its warehouses need to get up and running. It sells a lot in store because it encourages that community building, but it doesn't have a great online journey that also needs to be improved. And it's got some challenges with 3D printing, the way it engages the community, etc. So work to do there. Amcor, I think I've already spoken about, so I don't want to spend any more time. Genius had also a reassuring trading update. I like it. Again, here I jumped into this way too early, but I went on a investor call at the end of January. Don't believe it has any existential problems and might average more into it, but for now I might be at the end of my risk tolerance, so I might just be sitting on this. But at the moment I'm down about 40%, unfortunately, so that's pretty nasty, that one. Phoenix, this is down a little bit, but it did go ex-dividend, and it has quite a chunky 8% yield per year, but it pays out twice, so that's basically minus 4% from that point alone. I think this is actually really undervalued in terms of insurers. In general, I like UK insurers, as I've spoken about beforehand. I'm actually going to be reinvesting my Phoenix dividends when it comes in, about £300. That'd be a nice one. Also, as well, this has had a couple of analyst updates, so I feel more bullish and very confident on it because it's way below those updates. But again, I just like the business model, and insurers feel like a good place to sort of conservatively park money at the moment. Fever Tree had an interesting earnings result, and I did a video on Fever Tree basically saying this is currently a hold. I'm up a little bit, but actually a lot of that is from previous sell, so I'm about flat at the moment in terms of my unrealized position. Yeah, for me it's a hold. I would consider selling this in like the 23 to 2400s and buying more in the 1550s. It's currently hovering around 18, and to me is a sell. It's got lots of potential, but lots of execution risks that shouldn't be overlooked. T-Row, for me, it's kind of trading on long-term lows in terms of its multiples. I get it. I get the kind of exposure to the wider economy. I get the threats from both free brokerages and robo traders, but to me it's a good proxy play. And I think I have a good buy price here in a mid-sized position, so great. Salesforce, I'm actually now green as of today, but modestly red here. I like the solution, particularly the Tableau element of it, the visualization tool. My wife also does project management stuff for Salesforce and is also positive on it as well. I just think it's, again, building a good suite of products, and I'm reasonably happy with my buy price. Could have got a little bit better, but I'm okay with it. Polymetal here, my gold hedge, which has not performed well because it's Russian focused, so that's unfortunate. S4 Capital here, this is kind of an interesting one because, and this is outside of my top 10 now, so hopefully this is some new information for everyone who does follow these videos. So this is an advertising agency headed up by Martin Sorrell, Sir Martin Sorrell, who is definitely a legend. They have delayed their results for a couple of times now, which has got people worrying. For me, reading, updates from both S4 as well as their auditor, it sounds more of like a bureaucratic thing, complexity of lots of acquisitions. I don't believe that Sir Martin Sorrell would risk his reputation, and he certainly doesn't need the money to commit fraud or anything like that. So actually, I took the opportunity to sort of significantly add to my position with this and average down. I think I've got an average of about 430 at the moment, and the shares are about 330, so I'm definitely pretty red here. You can kind of work that out right from the current worth and the P&L, but that's how that's currently looking. Facebook, I opened a position very recently just following the fall when they had to spend money moving into the metaverse. For me, it just basically started to look like a value play. Again, I could have got it been slightly more patient here. People were a bit more patient than me, have got better averages. But again, this turned green today, and I'm quite quietly confident. My general view here is that this is going to probably be just a short to a medium term hold. And when the updates come through over the next quarter or two, it's going to be a case of right, actually the transition is working. The threats from the advertising changes in Google and Apple aren't as serious as thought, or they found ways to pivot, or etc. Or it's going to be a case of actually those worries are completely founded, and I'm just going to sell out now. Like, I think it's going to be one of those two situations, and the share price is going to respond, and if it goes up, I'm going to take the opportunity to sell. And if it goes down, I'll probably sell, because I'm assuming it's going to be because it's bad news. Cerulean I do want to talk to, so I'm green on this, and I almost wish I wasn't. This is a company that's so in my wheelhouse, it's ridiculous. I've actually spoken to this company from a job perspective. Basically, it does billing software in the telco world, as well as CRM and that kind of stuff as well. Basically here, again, they've built a very good suite of products. The kind of billing solutions, they take a long time to get up and running. Like they need scale. It's difficult to sort of get a company to replace such a key part of their system. But I like what they're doing. I would buy their system. I can't really give a better better verdict than that ultimately. So it does have a bit of a gross buy sell spread here, but to me, anything under £9 is a buy. It's currently about 8, so it's not quite the bargain it was just a couple of weeks ago when it dipped to like 6.5. But I'm looking to add to my Cerulean share moving forward. Aviva I got back into, having sold out at 442 once I considered the turnaround effectively complete. And this fell, mid-month, and I just decided again, I was picking up money and picking up shares in like the 300s, which just felt too good, especially because I'm buying shares with entitlement to a very significant special dividend in a couple of months, as well as the more regular dividend. I expect to hold Aviva for about another year before I simplify everything and put it into Legal and General, which I do think is a superior business, but Aviva is part of a turnaround at the moment that more or less is completing. The reason why I'm keeping Aviva for another year is because they basically committed to raising their dividend by 15% next year, and I think that's worth holding on to for an extra year, basically. So that's the plan with Aviva. Legal and General, I think, is one of the safest places you could put your money. It's a superb, well-run business, great financials. It's just, there's a lot to like about it. I don't even think it's particularly expensive, and it has something like a 7% yield. So again, this is going to be like one of my safe places to put money, because apparently Russian miners isn't where it's at. And next up is Crichton's. This is a small consumer discretionary, does things like special soaps, high-end soaps that my wife likes. I think this is looking quite cheap. It's sold overdone in my opinion, because it has relatively tough comparables against the sort of hand gels that they were selling during COVID, but it's still a really good little business that has a war chest. It's well run. It's my smallest business actually that I own. It is a real small business, under 100 million market cap, but I think it's got a lot of potential, and again, I'm going to be looking to buy into this in the future. Redrow is my house builder of choice. This is a bit of a turnaround play, but they're ultimately just pivoting from the southeast away, because it's like higher margins, although lower revenue, but better for earnings, and quicker turnaround in terms of planning permission as well. So again, to me, I think you could basically throw a dart into the UK house builders market at the moment, and it would basically hit anything that would be a buy. There are lots out there. I also like Persimmon, which I've owned before. I like Vistra as well for a kind of value play. Barra, I think, is perfectly reasonable. There's lots. The whole sector's got buys across it. trade on modest multiples. There are a couple of concerns basically about input costs, but really there's a cladding scandal in the UK at the moment that house builders are likely to have to pay some money toward, and that's got a lot of people jumpy. But for me, I look at the long-term trends of, Brits and people living in the UK want to buy homes. Not enough homes are being built. The UK's population is projected to increase. I just see a fundamental problem here that's only going to send prices up one way. So I think house builders, again, are a good place to put money. A lot of them also yield very well as well, actually. Everaz, Russian miner, let's gloss over that. Then we've got a Scottish Mortgage Investment Trust, normally just called SMT because that's a mouthful. Down very slightly on this. I probably would have averaged down when the price was under £1. Sorry, I guess £10. I'm just down a few percent now, so I'm not going to be doing that, especially because I plan to be adding to big tech positions as of next tax year. So I guess I'll probably keep my SMT position at least for a little while. But yeah, I'm just going to sit on this. I have a pretty good buy just above £11, I think. I'm happy enough with that. It's not quite the worth me averaging down, and I'd rather just keep to open positions in the likes of Amazon or Google, which is the plan. Kanos though is an interesting one. I guess it's kind of similar to Cerulean, not so much in my wheelhouse, but this is like a digitization project kind of company that you call in to sort of automate, simplify, etc. However, like, look at the numbers. I mean, they're really impressive. It's already hit a scale where it's kind of throwing off money. I think a lot of potential for this company. It's growing really rapidly, making smart acquisitions and moves. Yeah, I'm pretty excited about it. So I will definitely be buying more in this. For me, I think it's anything under a 14 is a really clear buy. So this might be one of my more aggressive acquisitions, just because I'm actually kind of optimistic I might get like a multi-bag on it. It might not look that way at the moment with its modestly red, but yeah, I'm quite optimistic on it. So I'll be looking to build a position. Dot Digital is sort of my least favorite of the small UK tech stocks. It's kind of a mailing system that is pretty smart in what it does. It had results that saw it get a bit beaten up, but I was actually quite okay with it because really the reason it got beaten up is because it was flagging the fact that out of bundle usage is going to be decreasing, but actually their recurring revenue should be increasing. So for me, it's like, well, okay, that's not so bad, right? A lot of tech companies or telco companies, that's the direction of travel they want to be going. So yeah, so I guess it's my least, the one I'm least excited about, just because I think it's the easiest to sort of replicate. It seems to have like the least like USP or differentiation. Honestly, it's just the one I'm least excited about, but I also don't dislike it enough to get rid of it. So I'm probably going to be sitting on this, but I'm not going to be looking to add to this one. Elixir is an interesting one. I am looking to add to this. It has a really horrible buy-sell spread, a really tiny company that basically bills itself as sort of a management consultancy, but it's really small. But they managed to pick up a new staff member from, I think it was KPMG, like very senior head. So that's encouraging that they're sort of able to pull in like real talent. They actually released some numbers super recently this week, and they look really great. I mean, like the revenue growth is up like 80%, already very profitable. Made a cracking acquisition on a kind of data-driven company on like a multiple of 6. I think they got a real steal. And I guess, again, I just like the direction of travel here. So I'm going to be probably averaging into this quite slowly because I don't want to get stung by that big buy-sell spread. But actually, I kind of at the same time do want to fairly rapidly build up a stake, and get it to probably a good like 1% of my portfolio, somewhere like that. So basically looking to like 10x my position size in Elixir. And Vicky, I'm basically looking to buy Vicky under 28. I sold out of it to buy, I think it was like Phoenix actually. I just think it's a fine place to put your money. I think it's like increasingly looking like a stable business, and I like the direction of travel. I think it's got some good upside, into the low to mid 30s. So I would definitely consider buying more Vicky. For me, 28 is the cutoff. And in general, REITs I kind of want to get back into, but Vicky to me seems like the most obvious one as it stands at the moment. So that is an overview of everything. I did also write this as well, but honestly, it's literally what I said last month. Again, it looks really red. I feel kind of okay about it because, again, I've had this for a month now, so kind of mentally I've reset. Obviously, my Russian miners there, it's pretty gross, and I would say that maybe, clearly I wasn't patient enough buying into positions like Gamma and and Genius. But saying that, at the same time, I'm currently sitting on like a 12% margin for Viva and Legal. Tiro, likewise, I moved pretty quick, and that looks pretty good. So I think it's like one of those things where I need to just at least be consistent. And to be honest, for next tax year, I'm going to sort of be taking a more risk adverse approach. Again, I'm feeling a bit bruised. And basically look to average in reasonably slowly. If that means I leave some money on the table, fine, but it should also mean that I won't be sitting on such big red numbers, which I can wear on you, to be honest, a little bit. And again, I find myself like really hanging on to any news from like again, Genius or Gamma or even Games Workshop. It's like, what's going on? Like, is there something that's going to change this position fundamentally? So it's like, and that's not good, of course. Like, and so I've read up on all of these companies. They're long-term holds for me. I have no plans on selling them. And then it's just a question of whether I average into them more or not. So, and for some of them at least, I'm not decided yet. But for Gamma, Games Workshop to a lesser degree, but Gamma especially, and others if I have the opportunity to, I absolutely do have the conviction to continue buying into them. So that's my overall portfolio as is currently. Hopefully that's interesting for everybody. Questions, etc. in the comments. Maybe just have a laugh about it. That's fine too. I've got thick skin. I've been the Boss Hog. Thanks very much for watching, everyone, and good luck with your investing. Bye for now.